Where are the risks in what the Fed said today, and where are the all-out positives? To our brilliant panel here, Mark Vitner is senior economist at Wells Fargo, and Bill Lee is the former head of the North American economics at Citigroup and former senior economist at the New York Fed. He's now the chief economist at the Milken Institute. Right away, Mark, I need to know your reaction here. The markets are definitely winners here.
I'm pleased because I think that the Fed's previous messaging gave a lot of investors and a lot of folks in general the impression that they were somewhat out of touch. And they assumed that the economy was strong enough that the balance sheet reduction could remain on autopilot. They could continue with enhanced forward guidance in terms of interest rates, and were of a mindset that interest rates were set to go much higher. That's all been taken away, and they've also removed the language suggesting that the economy is strong, which I think is absolutely right. I've read some other folks' research where they're questioning that, and I think it's absolutely right. Look what's happening to housing. Look at this morning's pending home sales data. It's not a one-month aberration. It's been weakening for 9 months. Look at what's happening in the manufacturing sector. The ISM fell more in the month of December than any month since December of 2006.
Can I just jump in here, Mark? But what about the labor market, which is absolutely pristine, best it's been in 49, 50 years. We just got the ADP number, that's private employment precursor number to the jobs report on Friday for January. This was a gain of 213,000, far outpacing what was expected.
And they did leave that language in there. They said that the labor market was strong. And the labor market is a little bit of a laggard. And you have to remember that we've had so many more job openings than we've had unemployed people that maybe it's going to take a little bit longer for the labor data to catch up with everything else.
Bill Lee, you were always against the Fed drawing down or rolling off the balance sheet at the pace that it was. They're still going to knock $50 billion per month off of that $4.1 trillion for now. But what would get Powell to stop it dead in its tracks?
I think, Liz, Powell already said to us the balance sheet is part of the policy toolkit, and we'll knock it down or raise it depending upon financial conditions and the incoming economic data. That's totally new. What we heard before was the balance sheet is going to steadily decline, and we should be as boring as watching grass grow. Guess what? That forecast went totally out the window. It's no longer the grass growing. It is the primary indicator that the markets are looking at toward the Fed to give us an indication of how concerned they are about financial conditions. And Powell told us we are concerned about financial conditions if the volatility and drop in the stock market is persistent. That's the key word, persistent. Now we have to figure out what they mean by persistent. But right now we know that the last quarter has got them scared.
Was I imagining it when Powell said the economy is strong, Mark? He said it. And now I just think that he has to justify why suddenly there is a freeze, not to take away from what's happening in Minnesota and Illinois right now with those sub-zero temperatures, but there's a freeze on all of these things that he had been doing as if the whole world is really coming to an end, yet he won't say there's a recession because there isn't one.
There isn't one, but one of the primary transmission mechanisms of monetary policy is the housing market, and the housing market has been weakening in a very significant way. The cyclical impulse from the economy, the economy gets is usually from the manufacturing sector. Even though it's a small part of our economy, it tends to lead changes in momentum. And I think that the other thing that the Fed had to take into account is that it was very hard for them to quantify what the impact of quantitative tightening was. They didn't know how much of an impact it was having on the economy. And when you don't know what the impact is, risk premiums increase. And the term premium increased more than it should have. And I think that's what they're realizing.
As we're doing this, we're looking at the S&P 500, folks. It is jumping 40 full points right now. That's a gain of 1.5%. Bill, I'm going to ask a very specific question here. Low rates. And we're not as low as we had been, but we're at 2.25% to 2.5% here on rates. Low rates tend sometimes to inflate asset bubbles. Are you seeing any asset that is suddenly turning into bubblicious quality here?
It's very hard to find that bubbly effect, especially in this environment where the Fed has already started to renormalize these rates. We're no longer at zero rates. We're at zero real rates, perhaps. We're certainly not at zero nominal rates the way we were before, and the balance sheet is tightening. So as the Fed starts to normalize its policy and now has paused, we see that the market reaction to that is, wow, the economy is going to be doing well. The Fed is not going to choke off the recovery. The Fed, in fact, is going to try to feed the recovery for as long as possible, because part of its dual mandate is maximum employment and price stability. Inflation, we know, is already muted. It's not an issue despite the strong labor market. So the Fed will continue, and I think the markets are on a good path to go up further.
Okay, Bill Lee and Mark Vitner just made me less suspicious of what's going on around here. But you know me, local news girl, I'm always cynical here. But guys, thank you so much.